Welcome to Business with Louis, the show where we dive into the world of entrepreneurship and explore the concepts that can make or break a business. Today, we're talking about choosing between debt and equity financing, a crucial decision that every entrepreneur faces at some point in their journey. So, what is choosing between debt and equity financing? In simple terms, it's the process of deciding whether to fund your business using debt, such as loans or credit cards, or equity, which means selling shares of your company to investors. This decision can have a significant impact on the future of your business, so it's essential to understand the pros and cons of each option. To start with, let's look at the historical background of debt and equity financing. The concept of lending and borrowing has been around for thousands of years, with ancient civilizations using loans to finance trade and commerce. Meanwhile, equity financing has its roots in the medieval period, where merchants would sell shares of their ventures to investors in exchange for capital. One key concept is the cost of capital, which refers to the cost of obtaining funding for your business. When you take on debt, you're essentially borrowing money at a certain interest rate, which can add up over time. On the other hand, equity financing means giving up ownership stakes in your company, which can be a difficult trade-off for entrepreneurs who are passionate about their vision. The Modigliani-Miller theorem is another important concept to consider. This theory states that the value of a company is unaffected by its capital structure, meaning that the decision between debt and equity financing should be based on other factors, such as tax implications and financial flexibility. However, this theory assumes a perfect market, which doesn't always reflect real-world scenarios. To illustrate how choosing between debt and equity financing works in practice, let's look at some real-world examples. Companies like Apple and Google have used debt financing to fund their operations, taking advantage of low interest rates to borrow money and invest in new projects. On the other hand, companies like Facebook and Airbnb have relied on equity financing, selling shares to investors to fuel their growth and expansion. For instance, when Mark Zuckerberg decided to take Facebook public in 2012, he opted for an initial public offering that raised $16 billion in capital. This influx of cash allowed Facebook to expand its user base, develop new products, and acquire other companies like Instagram and WhatsApp. However, it also meant that Zuckerberg had to give up some control over the company as shareholders gained a stake in the business. Another example is Airbnb, which used a combination of debt and equity financing to grow its platform. In 2015, the company raised $1.5 billion in funding from investors, including private equity firms and venture capitalists. This investment allowed Airbnb to expand its operations globally, develop new features, and build a stronger brand presence. So, what are some practical tips for entrepreneurs who are trying to decide between debt and equity financing? First, it's essential to understand your company's financial situation and growth prospects. If you're just starting out, debt financing might be a better option, as it allows you to maintain control over your business. However, if you're looking to scale quickly, equity financing might be the way to go. Second, consider the cost of capital and the potential risks associated with each option. Debt financing can be more expensive in the long run, especially if interest rates rise or your business struggles to repay loans. On the other hand, equity financing means giving up ownership stakes, which can limit your control over the company's direction. Third, explore alternative financing options, such as crowdfunding or venture capital. These alternatives can offer more flexible terms or lower costs than traditional debt or equity financing. For example, platforms like Kickstarter and Indiegogo allow entrepreneurs to raise funds from a large number of people, often in exchange for rewards or equity. Finally, remember that choosing between debt and equity financing is just one piece of the puzzle. To build a successful business, you need to focus on creating value for your customers, innovating continuously, and adapting to the ever-changing market landscape. In conclusion, choosing between debt and equity financing is a critical decision that every entrepreneur faces at some point in their journey. By understanding the core principles and theories behind this concept, entrepreneurs can make informed decisions that drive business success. Remember, every great entrepreneur has faced this choice, and with the right knowledge and strategy, you can navigate this crossroads with confidence. As my friend and fellow entrepreneur Gary Vaynerchuk once said, the best way to get started is to quit talking and begin doing. So, take action today and start building the business of your dreams. Whether you choose debt or equity financing, remember that it's just one piece of the puzzle. Focus on creating value for your customers, innovating continuously, and adapting to the ever-changing market landscape. Join us next time as we explore more concepts and strategies for entrepreneurs who want to build successful businesses. Don't forget to subscribe to our podcast and follow us on social media for more insights and updates from the world of entrepreneurship. Like, share, and subscribe, and remember, every great business starts with action. Make your next move count.